I'm so excited for what we're going to talk about. We're going to have a debate that has raged on for ages. And it's all about which way of investing is the most profitable, active or passive. And you're in for a real treat today because we've got two experts that are going to help us figure it out in real time, right here, right now. We got one on each side of the debate. So let's see how it turns out. First up, we got Frank Litke, our very own from Ally Invest. He's going to take the passive side of the argument. But then from VectorVest, we've got Steve Chappell. He's the Director of Trading Systems Development, and he's going to take the active side of the debate. Thank you for joining us both, gentlemen. But before we get started, one housekeeping thing, just got to remind our viewers one more time, we do take questions at the end of these sessions live right here. Steve and Frank are both going to answer your questions, but you got to type them out in the chat box on YouTube or in the comments within Facebook or LinkedIn, and we will get to them as many as we can at the end of this session. All right, guys, we're going to pull a few of our viewers right now. We're going to open it up with a poll question about, do you consider yourself an active or passive investor? We want to know who's watching us right now. And guys, you know the drill. It's the end of the day, ally.com/live poll. You can click on that link within the YouTube chat, and this question is going to pop up. Select your answer, and we'll see who's watching us today, and we'll talk about it after I give you a couple minutes. While I give our viewers a couple minutes to answer that question, let's define active and passive investing, just to kind of set the tone for the conversation. Steve, why don't you start us off? Give us an explanation of what active investing is. We've got a slide to help you explain it.
All right, thanks so much, Lindsay. Do you mind if I tell a quick story, just to kind of cut the ice here a little bit? And
go for it.
Get everybody involved and hopefully entertained here a little bit. So quick story, guys. I was out to dinner last night with a couple of buddies, and just for, to be totally PC, let's just call one buddy Mr. Fundamental Investor, and we'll call the other buddy Mr. Technical Trader. Okay, and so the night kind of goes on, and we order our nice steaks, and we're sitting down, and we're getting ready to tear into those things. And I look over and I'm watching this conversation unfold between these two guys, and it started to get very heated. You could see their faces really starting to turn red and that kind of thing. And before you know it, the technical trader gets so mad, he slams his hand down on the table there, and the steak knife goes twirling up into the air, and it comes down and it lands right in the fundamental investor's foot. And so the technical trader said, whoa, why didn't you catch the falling knife? And the fundamental investor says, well, because I thought it was going to come back.
Frank, what do you think of that?
My story is probably a little bit more simple. I sat my two friends down at a campfire and said, do you want to make $1,000 or do you want to make $800?
Yeah.
At the same time. And the guy on the left said, I want to make $1,000. And the other guy on the right said he wanted to make $1,000. So I said, welcome to fundamental passive investing.
There you go.
All right. And that's how we're going to start things.
All right. So sorry for that aside, guys. I think you wanted me to define active for you, Lindsay.
Yeah. Give me what is active investing?
Okay. So the way I like to lay it out, at least in my terms, would be we like to stay consistently plugged into the stock market. We're always looking for new opportunities on a very frequent basis, almost daily basis in most situations. And that gives us a lot of ability to be agile and always be looking for what's hot and participating in the hot segments of the stock market. So, just as a quick sort of example of that, if I work my way just through, this current year that we're in, which has been quite a year, hasn't it? I mean, oh my goodness. But you kind of started out the year in normal modus operandi. The stock market came into the year pretty good. We had a pretty good January, February, and then the COVID situation hit, right? And so as an active investor and always trying to stay plugged into what's happening in the stock market, that became a great opportunity to dive into what are called inverse funds, where they work counter to the direction of the stock market. So I can profit in situations where an underlying market that ETF represents falls. Then as we experience quite a collapse and start working our way up off the lows, the easiest thing for me, because at that point, guys, we didn't know what was going on, right? We're all scratching our heads. The easiest thing for me was to go after gold, because one thing we knew for sure that was going to happen is that there would be stimulus. That was going to be clear. That's the only way to dig out of the hole. So naturally, under those conditions, dollar weakens, gold goes up. And then you moved into, more of the coronavirus stocks, the stay-at-home stocks, the big tech. And where I've been here lately has been clean energy. So that's a long-winded explanation, but I wanted to walk people through it. So it's more than just words. It's, tangible things, and they can tell I'm real, and it's tangible on to there.
All right. So that's a great explanation. It kind of is interesting how you worked your way through the pandemic to the point, the rebound in the stock market to get us where we're at today. Now, Frank, what about a passive trader?
Yeah.
What's the definition for us, first and foremost, and then how would they have approached the last, 8 months?
So thanks for having me here today, Lindsay. It's great to be with you, and Steve as well. So we'll start off with that. When we think about passive, it's not somebody who's disengaged or disinterested or lazy, but it's somebody who values the long-term proven performance of the stock market. A passive investor sets an investment strategy that's personalized along their goals, time horizon, risk tolerance, and avoids the temptation to time the market or sell when the first sign of volatility shows. A passive investor looks at that plan as a way to even out returns over a number of years. Depending on what your time horizon is, portfolios can be adjusted based off of equities and bonds and other holdings to take those considerations into account. Maybe some of your goals are a new house or a shiny new car. That can all be worked into a plan. A passive investor looks at and stays disciplined during the time that we saw in 2020 of a lot of turmoil. Make no mistake, people that, if we go back to that slide that really shows the wild year, if you decide to jump off at some point in the month of March to the trough, you're looking at 40, 30, 40%. The rough part of that is if a passive investor sticks on their goals, their returns are going to be evened out. Since 1950, the average return of the US stock market's about 8%. And passive investors will set up their goals and take that risk reward tolerance and stay engaged. You can watch the market, you can see what's going on, but they have a view that the long-term returns will eventually outpace trying to time the market. That's the fundamental definition of what a passive investor, long-term investor is. And we'll get into some more of the specifics in a little bit.
Yeah, I mean, I think you bring up a good point, Frank. That chart that we were just showing was a longer chart of the S&P 500 with gray bars that highlight bear market, or excuse me, corrections. So drops of 10% or more in the S&P 500. And you see the longer term trend is up and to the right. And so history shows us that being longer term investing, at least you tend to have positive returns over the longer term. At least that's what history says. But Frank, are you saying, just, this is a debate here, are you saying that active folks, active traders don't have a plan? You talked a lot about the passive having a plan. Does it mean active doesn't have a plan? And then Frank, or then Steve, I'll let you counter.
So active traders definitely have a plan. I'm sure that most technical trading systems have a plan baked within it. However, over the past 10 years, 85% of active large cap fund managers have failed to beat the aggregate market return of their benchmark index, like the S&P 500. So even if you make that longer time horizon, active trading, trying to pick individual stocks and beat the market just doesn't show. I mean, you can listen to Warren Buffett or anyone else. He's done an incredible job at actively picking stocks. There's no doubt about that. But his overwhelming advice, given what the data tells us, and given that professional fund managers with armies of analysts and quants that are smarter than me and a lot of folks can't do it on a sustained basis. Even if you shorten that time horizon in 5 years, their old argument was that wait till volatility returns. We'll be able to beat the market. 5-6 year time horizons fails to show that.
What say you, Steve?
Well, the answer here is actually pretty clear, even on the chart that you have in front of you. Again, those large fund managers that we're mentioning oftentimes are 100% long all the time. And while they might be active, they're not active in necessarily the right way. So, for example, if we just look at the left-hand edge of the current graphic, if you're simply going to attack the market by putting more money in every month as the stock market continues to decline, what you see is that the market usually dips a lot faster and stronger than the rise that comes out of the low. And so it can literally take years, sometimes decades, for you to ever get any real return on all of that money that you continually tried to pile into the market on a month after month after month basis. One only needs to look to Japan as an example of a stock market that still is trying to get back to the highs of 1989 to put some kind of forward tape in play. So, it's always that battle. And I'm not saying either way is absolutely wrong or correct. What I'm trying to point out is the active case, right? So the active case to me would dictate you're far better off. And one thing that comes to mind here as I get into this is the whole notion of timing the market. I want to make one thing plainly clear. You cannot predict market direction, but you can certainly time the market. And what that should amount to is being trend followers. So, and often there's different levels of even investor temperament involved in that, whether you want to be trying to get in within a few days of a market bottom, a few weeks of a market bottom. If you're more conservative, for example, would be a far better solution. At VectorVest, one of the things that we do is cater to a wide variety of investors. And so some of them are quite active. They're willing to play, hey, look, even all those bumps and wiggles on the way down. Sometimes you're long and short as the market's actually going through that entire decline. Whereas more of our conservative investor would literally sit out the bulk of that downturn, wait for the market to not just turn up for a day or two, but turn up for several weeks before they even feel like it's worth buying stocks again. I mean, that would be the first two things that just kind of come to mind.
So just for a point of clarification, we mentioned days, months, years, decades to get your money back. The longest, most sluggish bear market in 1973 took 5 years and 7 months to recover from its trough to a recovery point. The average recovery is about 5 years. So certainly there are periods, if there are liquidations in between recoveries, that can, present opportunities for short sellers or speculative traders. But for the retail investor, if they can stay in it within a 5-year horizon, and that longest in the tooth that I mentioned in 1973 at 5 years and 7 months, they are certainly better off in the long term.
Yeah, I think that's a fair point. But Frank, what if in the last during the depths of the pandemic, a passive investor didn't have that discipline that they need to stay passive, stay invested, and instead they sold some or all of their investments close or near to the bottom? What would your advice be now?
My advice, first of all, is probably need to stick to your plan and not do that. I mean, that's one of the advantages of a long-term plan, Lindsay, is to look at your time horizon and largely ignore short-term blips. If somebody had done that, you need to reevaluate your plan. And you need to look at everything holistically and understand, here's what I've done, here's where I'm at, how can we recover it? It's really important, if we talk about long-term plans, and if you believe at that 8% annual average return that your money is going to double roughly every 9 years, you have to have the wherewithal and the understanding that even through these bear markets, the investing investing overall in the stock market has its ups and downs. There's been no linear period longer than a couple of years that's straight up. So you have to have the wherewithal and the discipline to stay on the plan. Timing is very, very hard. So a few things, even if they had sold, a few points I'd probably make. One, you got to stick to your plan. We've gone over the data. I talked a little bit about annual average returns and the power of staying in your plan. The market's not linear. Stick to your plan, continue to contribute. Now, unforeseen circumstances certainly happen. And if you need to pull back principal investment during times of hardship, like a lot of folks went through in Corona, certainly understandable. That's not going to totally derail your plan, but you need to try to get back to it and stick to that plan. So one of the ways to do that, it brings me to my next point, is to really make it automatic. If you can make your contributions to your wealth management and your investing plan automatic, it'll seem more like a contra or deduction to your paycheck rather than an expense that feels painful coming out of your bank account and paying into it. This is a proven strategy. There's been several studies and research that shows that if you can automate your savings and do it, pay yourself first. You've heard Callie talk about that today. A lot of folks have talked about that in the long term. You have more likelihood for success in the long term. And the third point is probably always go back to the why. Why am I doing this? Remember my goals. Often in periods of volatility, it's natural human reaction to have this fight or flight reaction. Am I going to keep fighting, keep putting money in, or am I going to pull out and get scared? Remember your goals. If your goal is to retire in 20 years, why would you let a 5-year, at the most, historically speaking, bull market deter you from continuing on that goal path and derailing it? If you don't touch it and continue to stay on your plan, you always have to go back to that why. And maybe there's an emergency expense, and that's totally rational to look at that. But recapping, stick to your goals, make it automatic and pay yourself first. And remember why I'm doing this.
All right. I want to go back, though, to the poll question that we asked at the beginning, just to see who we got with us. You consider yourself active or passive? And it looks like the majority of the group is passive, but we have a decent amount of active investors watching as well, too. So we'll see if either of you can convince each side to flip after today's debate. Are you surprised, Steve, at that response, that we're seeing more passive viewers on this conference?
I'm actually not. I think as we were coming together as a group and talking about how this was going to go today, a week ago, I think that's the first thing I said was I thought there would be more passive. That just comes from, the 19 years of experience that I have. I think that's where most people fall. But there's dangers with being passive that we haven't talked about here as well. And we'll maybe come back to that a little bit later on. But it definitely does not surprise me that to answer the immediate question.
All right. Steve, how does an active investor, we just heard Frank talk about passive investors, if an emergency happens, maybe pull back on some of your committed contributions to your passive account. How does an active investor, how do they react when they have an emergency that they have to think about, whether it's, for health reasons or loss of job or any number of other things? How does that factor into the active trading strategy?
Yeah, sure thing. So I don't know that I want to speak for all active traders, but I'm certainly capable of speaking for myself, right? And the way that I would handle that if I was ever put in that situation, which thankfully I have never been, but let's say loss of job during the coronavirus pandemic, right? As kind of the most recent case. Generally, what I'm going to do is leverage my knowledge of options and the, selling covered calls, selling puts to generate the income that I need to put food on the table and pay the bills. So one of the attributes of active investors is they take the time to get the education to learn the tactics that are appropriate and actually best appropriate for those types of situations. And so literally whatever that paycheck number needs to be, I can literally, I hate to use this analogy, but it's the closest one and the first thing that comes to mind. I can use the stock market as an ATM actually. And I can do it in a rather safe way. I heard Brian earlier in some of the presentations talking about how options were originally developed and so on to actually mitigate risk. And they do a great job of that. And that is absolutely why they were created. The other great attribute of options, and I think Brian would agree, you want to typically be a seller anyhow. It's the guys that are trying to hit the home runs in the options market by buying way out of the money calls and doing all this crazy stuff that really gets them into hot water. Whereas if you listen, there's hardly anything that you can do wrong by selling a covered call option. Just to give people, I like to give people things that they can take home, you know? And so a great book, if you've never read it, is How to Get Rich with Options. I don't love the title, okay? But the author of the book, his name is Lee Lowell. And he does one of the best explanations of the covered call trade that I've seen in literature outside of Brian's. I love Brian's options playbook because it gets right to the play, you know? And he does a great job setting things up in the forwards of the book as well. But another great one to kind of add to the library is that book. It's terrific. And, you know, I've worked with him not directly with him, but I've seen him at trade shows and other things and give presentations, and he's just really, really good. But that would be my answer. The other answer would be for the active trader. Very seldom, Lindsay, do we typically have all of our capital at risk in the stock market. On many occasions, I'm just riding 2 or 3 trades at a time. However, we might rack up, you know, a dozen or so trades in any given month. And so one of the nice things about being an active trader is you don't have to be all in. In fact, if you do things well and do things right, with even a fraction of the money, you can move the needle a lot more than 8% a year, I guarantee.
Okay, well, so I have a couple questions then. If not all of your money is at risk, meaning it's not all in the market at any given time, what are you doing with the money that's on the sideline? Is it in a cash account? What do you do?
Yeah, so typically you want to have some powder available. A recent example, right now I'm completely hedged. So I've got positions both long and short. I've got some inverse funds to give me some peace of mind as we're going through this current stimulus situation. I mean, just the notion that these guys, you know, Pelosi and Mnuchin will come to some sort of arrangement, regardless that it's still got to go to vote, will likely send the stock market catapulting higher, you know, only to maybe potentially a week later find it come crashing back down because reality sets in and maybe McConnell doesn't pass the bill, right? So, you know, what we do as active traders is we take a strong look. I would call it situational investing or situational trading in this case. I'm kind of giving away my final remarks. But, you know, you want to look strongly at the current market situation and you want to implement tactics that are consistent with the current market behavior. Right now, the stock market is sideways to down. So it's not down enough for me to commit fully to the downside. So what I've got is a situation where no matter which direction the market breaks, I would unwind the other side and then add to the fire on the correct direction once it becomes evident, which I think it will.
Okay. Frank, you've talked a lot about options there. How should passive investors think about options as a portion of their portfolio?
Not as get rich or guarantees. I don't know about all that. I kind of heard that and I said, woo, I know Steve is very passionate about his option trading. But no, I mean, options can certainly be a tool in any investing plan. I think, you know, as we think through the passive investor and what happens for a long-term investor in an emergency unforeseen expense, the first thing you're going to do is look at your cash flow situation. If you're not able to continue to contribute to what the long-term plan is, you're going to pull money back and try to figure that out. Steve talked a little bit about using your active trading account as income. This is for the really advanced sort of folks. I mean, you can certainly sell covered calls and do things like that, but the minute you become naked or uncovered on a position, or think you're buying or selling and it's you go the other way. Like it can be a tricky game that really is for more of the advanced retail broker dealer client. You can use options in a portfolio of ETFs or long-term funds, mostly ETFs. You can hedge your position in a long-term strategy using index options. A lot of folks do that as a hedge or protection against long-term declines. Now, in terms of making money or producing income, you can sell covered calls. If you're comfortable with your risk tolerance and really understanding and knowing what you're doing. Absent using options, discipline, and using your portfolio, like if you're in a total income loss situation as a passive investor, you can look at your portfolio and possibly draw on it. If it's a qualified retirement account, there might be penalties with that, with the exception of hardship withdrawals that might waive some of those penalties and you're just paying taxes. So you can still use your passive long-term portfolio for income. It might be yield from your non-qualified or after retirement accounts. If you've got a long-term position that pays dividends, that pays capital gains, you can use that to live off of as well. But at the end of the day, when things get back to it, discipline is key. You know, any good long-term plan, investment plan, is going to have a liquidation priority order in it. Meaning, something happens today, you do a few scenarios. What's the first thing that I'm going to sell? To buy groceries. What's the first thing I'm going to do? Movement in the portfolio. There is a way to deal with it. The same plan is also going to account for adjustments to those goals. Like, hey, maybe I'm not going to retire in 20 years now because of this pandemic and things that are going on. I've got to adjust my time horizon to look at 25 years, for example. But you can get back on track and use different tools in a long-term strategy. It's not like you're locked in and you have no options and you're not caring about what your portfolio return is. You can certainly still be engaged, albeit not super active.
Okay. I want to kind of switch gears here a little bit and kind of talk about newer investors when they're thinking about the decision to become either passive or active at the beginning. What's the best advice from your perspective? So Frank, from the passive investor perspective, and Steve, from the active investor's perspective, would you give to someone like that who, like I said, just starting to get invested right now? Steve, what's the active advice? And then Frank, I'll have you go.
So I've got a few things, I guess, really, you know, and I've had a few friends recently just start to get into the arena here, literally over the course of just the last several months. And some striking things have developed through just some general text conversations and then phone calls and, you know, things of that nature. So one of the things that I would just stress right out of the gate, and this helps to combat multiple issues, but it's just don't buy stocks on the way down. That can, if you're not really careful and know what you're doing, be the quick way to the poorhouse. For example, I've got a buddy who actually has a good position over here at Wells in Charlotte. And I've been trying to get him to sell his GE for about 3 years now, you know, and every time we get back together, you know, it's the same story over and over and over. Well, they just got a new CEO. It's going to start going now, you know, and now I hear they might be trying to get into the electric car, you know, segment and things like that. And so that'll be the story, you know, the next time we meet. One of the things that you don't want to do, whether you're active or passive, in my view, is buy stocks that are doing the opposite of what you want them to do. And that's, you know, go up is after you buy something, but you don't want to buy stocks on the way down. It can really get you into a lot of hot water. The second thing that I would say, and Frank's totally right here, I think Frank and I end up agreeing on a lot of things. I don't let the cat out of the bag here too soon, but you want to diversify. So we talked about how, as you know, as a trader, let's focus on that. Okay. So like I said, you want to stick to hot segments. That's where you're going to make the most return. We'll come back to diversification later. Okay. Here's a big one. And I think I found this common across all of the friends that I've been working with. And that is, they put X amount of money in this stock that's $50, and they put X amount of money in this stock over here. They buy like 5,000 shares of the $50 stock and they buy 5,000 shares of the $5 stock. Okay. Now, what that does is that creates a total out of balance portfolio. What you want to do is in my view anyway, when you're new, you want to equally dollar weight across all of your positions. So that means 10,000 in this stock, 10,000 in that stock, 10,000 in this stock, 10,000 in that stock. Just little simple things like this, I think, can move the needle for some of the people that you have in your audience, right now. So the other thing I would say is diversify not only in what you buy, but also when you buy. So I think, Frank's got it right there in a lot of ways too. Although I don't like buying stocks or markets on the way down, I do appreciate the idea of nibbling at the market lows and adding as the market continues to move your way. I like to cost average up, not down. I see more benefit in getting immediate returns on the money that I put into the stock market right after I do so, not having to wait sometimes 5 years or who knows, maybe even longer in the future to get a return on that money. And finally, I would say you need the right tools for the job. So check out vectorvest.com because we teach you how to do all of this. And I'll turn it back to you, Lindsay.
I had a little plug there. Yeah, I mean, it seems to me a lot of what you've been saying throughout this debate is all about, following momentum and following it to the upside. Frank, what's the best piece of advice, I guess I should say, that you would give a new investor that wants to get into passive investment?
Yeah, so there's a few key points I'd make to this person. So I've seen a lot of good questions today in the chat as we're going through about how much do I use? How much do I send into my investment advisor? How do I get started? Things like that. It's a great question. And the number one thing, I'm going to make it very simple for everyone. Everyone goes online and looks at reviews for Amazon, for their next car, for a barbecue grill piece that they're going to buy. They look at reviews. What are you doing? You're doing research. The first thing to do is start the research. There are an amazing amount of educational resources, such as our very own Lindsay Bell, that can teach you the very fundamentals and basics on where to start. There are a couple ways to get into it. You can do it on your own. You're a do-it-yourself person and self-directed, or you can find a robo portfolio, low cost, RIA, that's going to help you get into it, very low minimums and low fees. The biggest thing to do, just do your research. Just like Amazon, going to buy that next pair of shoes or whatever it is, start doing your research and checking that out. The next thing is understanding. Time value of money is very powerful. Compounding is one of the world's most powerful ways to accumulate wealth. Albert Einstein, huge fan of compounding. Can't go against Albert Einstein. The first step, do your research, understand what you might have there, and trust it. A couple other just general pointers. So the research and getting started, right? Compounding, getting started, do your research. A couple other overall points I'll make: patience. You're not going to get rich overnight with options. You're not going to become a billionaire overnight by some strategy that somebody tries to sell you in terms of super different market. At the end of the day, long-term patience and understanding with your goals and setting expectations is going to be really important. Personalize, be vocal, know what you not. When you ask the question, when folks ask the question, how much should I use to get started? That's different for every single person, depending on their income, their dependents, their monetary needs. I would challenge people, or one suggestion, start with 25 bucks. Weekly paycheck, take 25 bucks, recurring transfer. Pay yourself first, like the point I made earlier. Transfer it over to a broker dealer or an RIA and a robo if you choose that, and get started. Just get started. Do your research, get started. And that's a few kind of points at a high level.
Yeah, I think, I always say that, Frank, it just, whether active, passive, or anything, it's just investing is an important component of building wealth. We've heard it time and time again throughout this conference here today. We are big fans of it at Ally Invest. But you can't take advantage of it if you don't get started. So the first step is getting started, opening that brokerage account and depositing cash into it, committing to continuously putting a certain amount into that type of account on a regular basis, like you said. Now, Steve, one piece of advice I always give when people are asking about getting started is start small, like Frank was just saying. Nowadays, you don't need a lot of money to start. You don't have to buy Amazon, or what is that now, over $3,000 a share. Yeah. You don't have to start there, but you should start with something that you do know, that you enjoy researching. If you're a big tech geek and you love to know everything about the different types of gadgets that are out there and who's making them and what components go into the iPhone and who distributes those components. If that's your thing, that's awesome, and you might want to consider using the research that you know and the knowledge that you have about those types of companies to invest in the stock market. Invest in the companies that make those products or gadgets or supply those gadgets, because you already know a lot about them, and that could be something that you get started investing in, but do it with a small amount. And part of the reason I say that is to get used to the volatility of the stock market. We've talked about volatility ad nauseum over the last several months. Brian over BNI, especially Brian, closely follows the VIX with the options contracts, and the market's been moving big this year. I think it was 47% of the days this year, we've seen the market move 1% or more. That's a lot. That's a lot. The market's still up for the year. Anyway, the reason I think that individuals need to start small is to get used to that volatility, the up and down of individual stocks, or even the up and down of, if you're passive and you want to buy an S&P index fund, the SPY or the VOO, those, you just need to get used to the volatility, especially if you've never invested before. You just get used to the ups and downs of the market. Now, Steve, how does that play into active investing? Because that's what you're exactly looking for, is the volatility and to make profits off of that volatility. How do you look at it?
Yeah, volatility only helps the active trader, that's to be sure, but you have to have a plan, and we keep coming back to that. The main thing is to discover a technique that you feel is going to work well for you and follow it, and I encourage the idea of starting small, just as you said, no matter what that plan is going to be, whether it's going to be active or passive, in fact. But this would be a quick example of an active trader, a trade that we actually did here. For people that aren't aware, when I say a trade that we did here, at VectorVest, we also have a live trading room where we do a lot of coaching, and people get to watch us trade. So that's the eye opener, is when people can have that opportunity to even watch somebody actually do a trade, right? Actually give you a technique that you can take into the future and try to emulate and do again. So this is Jazz Pharmaceutical. One of the things that you see that is a clear earmark of any professional trader that you study that is worth any grain of salt. One key ingredient that they have in common is that they all look for a strong equity to begin with. And what I mean by that is it's just working its way up the page. They might use an indicator like in the middle there, ADX, to get a better understanding of how strong the trend is. And when it hits over 30, you're on strong trend and you're looking for your setup. When price comes back to the moving average, we look for what's called the KISS, right? When that KISS candle occurs, we then put a buy stop order out above the high to take the trade. If it doesn't hit, we don't take the trade. We know immediately where our risk is. The risk is always the low of the pattern on the touch of the moving average. So it'd be that green candle. No, over to the right, on the KISS of the moving average there. Kind of the tall, well, it's a dragonfly doji. That's okay. But then you have a predefined risk limit. So one thing as traders is we always know where our risk is. So if we're wrong, we're wrong. We're not wrong on this trade unless price goes below the low of that green day, okay? We also have a target, which is the prior swing high, at which point we typically would at least take half the trade off, if not close it. And then what we do is we just repeat that process over and over and over and over again. So there's actually very little risk involved in trading if you do it in this type of a fashion, because what this chart is showing you that may not be as apparent to somebody seeing this for the first time is typically there's 2 to 3 times potential reward to every point of risk that we ever take. Okay. And so if we're only right 40% of the time, we make money, and lots of it if you're actually even that good. Whereas when you buy and hold stocks, if you're not careful, again, it can get you into hot water if you have no plan. If you don't know, one of the things you got to know when you do anything, I don't care whether you're passive or aggressive, is you got to know when you're getting out. And I mean, not only at a loss, but sometimes even at a target. I mean, if you buy a stock and it goes up 100%, what are you going to do? I'll tell you the first thing I'm going to do. I'm going to take half the position off, and I got a free ride. That stock can go to zero and I'm not going to lose money, and I get any benefit of any future rise by taking that money off the table. So that's why traders do those kinds of tactics. If you can get to that point where you can reduce your exposure to the market, it's hard to lose money on that trade.
Yeah, I think what you're talking about, Steve, is really risk management.
Yes.
Investing, let's be honest, again, whether you're passive or active, it's all about living to see another day, right?
Mm-hmm.
And the only way you live to see another day in the market is to have a plan in place and to have a risk mitigating plan in place. And it seems like, especially from an active side, you're always thinking about what the exit plan is. I think passive investors, Frank, you'll probably agree, there's an exit plan too. It's
Sure.
a much longer term exit plan where you don't let blips in the market like what happened between February, March, and now rattle you when you have that longer term exit strategy. So it's all about time frame, and I think you both talked about that when you define the terms active and passive at the beginning of this session. But I do want to talk about risk management a little more, because there is a lot of risk when you're investing your money in the stock market. It's not all rainbows and sunshine and up and to the right, like the charts that we've shown for the longer term S&P 500. There's going to be periods of up and downs. What are the greatest risks to passive investing, Frank? And then Steve, I'll pass it to you from an active perspective.
Sure. So, Lindsay, I mean, you hit the nail on the head. All investing, no matter how you're investing, active or passive, involves risk. There are ways, however, to mitigate that risk. Think of driving a car. So I'm from the Midwest, Michigan. Snowy. I'm out there, hit some ice, bam, overcorrect the steering wheel, try to get back on the road, overcorrected, hit a mailbox. If I stayed on the path and just flew through the ice, I would have probably been fine, right? Not hit the mailbox. So that's an equivalent to understand that in any plan, you're going to hit some ice, whether it's active and you have something going on in the market, or passive and the broad market's down because of a macroeconomic event such as a coronavirus. Getting off that plan can increase your risk. So in terms of mitigating it, number one, you need to have in any strategy, particularly in passive, an emergency fund that's not necessarily invested in the market, that's exposed to principal loss, something like an online savings account or any other liquid, not risk exposed cash. So thankfully, there are ways to mitigate short-term liquidity needs. There's another way you can do it too. It involves a little bit more complexity if the investor is comfortable with it, and that's using index options or using options for your portfolio in passive investing to protect on the downside. Again, much more involved, but not necessarily totally off the passive profile, especially if you have an RIA and some of your different wealth management accounts. You can use index options or other options to protect on your long positions. When I think about risks of passive investing, is one of them is needing your principal sooner than you thought. That's when you go back to your plan though and use that liquidation priority. Hopefully you have the emergency fund to cover short-term liquidity needs, But then if it dips in beyond that, you can use your liquidity priority plan within your investment portfolio to rely upon that for whatever it might be. So anyway, wrapping up, there are some of those risks. We can mitigate it with a good plan, staying on track, using some options, and honestly, knowing your time horizon and really sticking to it.
Steve, what are the biggest risks that an active investor faces?
Yeah, so I think the biggest risk is getting caught on the wrong side, you know,
Yeah.
and that typically stems back to the initial thing that we said is that you've got to have the right plan in place, you know, a plan that's going to take care of that. So with the tools that I use here at VectorVest, we have a market analysis component. So we know when the market is healthy or unhealthy. And right now, you know, we're saying the market is not healthy, actually. So, you know, having tools that actually don't just supply data, but that supply answers, I think is hard to find, and yet something that everybody should at some point find. I'm not talking specifically to the people just starting out right now. I think you guys have laid out a great plan for them just to get started. I'm talking about people who have substantial amounts of money in the stock market. I think having a better understanding of what the market is actually doing can only be helpful, you know, but what you don't want to do ever is get caught on the wrong side of things. One of the things that we're most proud of, and just in recent times here, is we told our investors that the stock market was starting to turn sour in February the 14th of this year. We said that downside risk outweighs upside potential, and that was before the big events actually occurred. We got a confirmed call after it already began, which is, you know, kind of the next layer of signal there. It's a more conservative signal. That didn't come until a couple of weeks later on February the 28th or 24th rather. And then we didn't have a signal to buy stocks again until March. So, you know, having something like that, if you can find a tool that's robust, and by the way, we've got a complete track record of every call that we've ever made for the last 20 years, you know. So if somebody's thinking, well, that's great, you know, you nailed this thing. Well, we told people to use caution on March the 10th of 2000. We told people on November 2nd of 2007 that be careful, we could be heading into a long bear market. Do not be deceived by the endless parade of experts who will appear on TV and other places telling you to buy stocks. Now is not the time to buy stocks, you know? And so when you can go back and you can see a track record, that's the thing that you want to see about all these TV personalities and things that are on air that you can't, right? But if you can go back and look at a product that has an established track record, that can serve as a good basis. So I think we all agreed earlier, you were saying you got to do your research. I didn't really hear much on what that research should be, right? But with VectorVest, you will get that research, and it'll be more than just numbers. It'll be actionable information. And I'll kick it back to you guys.
All right, great.
Even with
debate, and usually you have to find a winner. Is it active Steve or passive Frank? I think I'm the judge here. So you know what? I think I'm going to call it a draw, because honestly, you both were saying a lot of the same things as what I heard. The main differences were time frame and the way that you approach the market. The time frame being the key. You got to think about risk mitigation. You got to think about your goals, and you got to have a plan, and you have to do research. Those are all things that you said. We're showing some summary takeaways for the viewers right now that you guys have put together. But to me, it seems like you're actually both on the same page here, just again, with different time frames and different types of strategies. Like Frank, I would say you're more focused on discipline, the research, both of your research, the different types of research. I think from a passive side, you're thinking fundamental research. You're all about compounding. You're about the patience and having the goals. Whereas yes. Steve, what you said today sounds a lot like you're looking for trends. You want to follow momentum. You need to consider hot sectors, but you also want to have equal dollar weights. You want to diversify as well. You have different types of research. It's on different strategies for short-term investors that they feel more comfortable with and know work for them. But ultimately, you guys said a lot of the same things. Do you think I came to the right conclusion here, Frank?
Yeah. So I mean, listen, any strategy, you're gonna miss 100% of the shots you don't take. Whether you get into the market and start to save for your future using an active strategy or passive, whatever works for you. At the end of the day, investing is about personalization and what's going to work for you. And if you don't have a plan that is personalized in this nature that's going to fit your lifestyle, your family's lifestyle, you're more apt to fail at it. So if you want to be an active options trader and feel like you can beat the market and feel like, or maybe you don't feel like you can beat the market, you just want to be actively engaged in options and picking single name securities. It's important, even and then, stay along the efficient frontier, research modern portfolio theory, understand diversification in your portfolio, and you can have an active approach. Passive works well for a lot more people, works well for people overall, just because of the fact that it's generally less time consuming as we all get busy with our life, dealing with children or jobs or vacations, whatever it might be. There are fits for each. So it's better to be invested in the market than not, in my view. And if it works for you to be more active, that's great. But for passive sides, we've seen some of the data points and how that fits in the investors' profiles as well.
Steve, what do you think of my assessment quickly so we can get to some questions?
I think you're dead on. One of the things that I battle with throughout the entirety of this presentation is that I actually do both. So I'm going to go ahead and confess up. Having said that, what I don't do still and never will is buy stocks when the market's going down. But other than that, I have a long-term core holdings portfolio. I generally buy puts as insurance when the market comes under pressure. If the market turns around and goes up, I simply liquidate the puts and away we go. And at the same time, I like to take a smaller portion of my capital and commit towards trying to move the needle more than 8% a year, trying to outperform the market. And our track record at VectorVest speaks for itself. So, but yeah, I think you came to the right conclusion, to be sure.
All right, awesome. I want to take some questions from the audience now. We've got a lot here too. So I think I'll start with one question that I think, Steve, you just answered, but I'm going to pose it anyway. Is there any advantage to using a mixed active passive approach? I put about 60% of my funds in an invested and forget it type of asset classes, but 40% I actively manage. The question is that bad? But I think it's more about the type of allocation, 60-40 passive, 60% active, 40%. What's your thoughts on that type of breakdown?
My thoughts on that type of breakdown is it's heading in the right general direction. Listen, I'm going to leave percentages and things like that towards the people who deal specifically with that. But the idea is correct. And whether it's 80-20, 25-75, 40-60, that's really up to the individual and their representation that they may or may not have. But ultimately, it's up to you as an individual, right? But I think more heavily weighted towards the long term is definitely the right beginning. And then if you're willing to leverage with a smaller portion of capital, I think that can do you an awful lot of good. This has been my best year ever. I mean, it really has.
Lindsay, as I think about that, the one tip I'd give to the person who asked that question is just make sure you're, in terms of the split, you've got to figure out what works for you. If you have more long-term needs, sometimes it's better to be passive and heavier on that percentage. But make sure you're viewing your portfolio holistically. You don't want to have positions in your active portfolio that overweight your passive portfolio in one sector, one holding, something like that. So make sure when you're looking at using a dual strategy like active and passive, consider your holistic beta to the market, your exposure to different sectors. Using something like an aggregation tool might be one good tip there.
Yeah, I think that's a really, really important point there. And I saw Steve shaking his head yes too, as you were saying that. You've got to you could be both active and passive, but you have to know holistically what your investment picture looks like. What are you in? Thank you for bringing that up. There's another question about, is there such a thing to be both? And we answer that question. But the question is there something like, is it normal to have one account goal that is active and another account that is passive? And I think the answer is yes. You can have two separate accounts. You can open two accounts with Ally Invest, for example, and one you can be very active in, the other you can be passive, or you can open one of our managed portfolios, which are our robo advisors, where we do everything for you for little to no fee, and the starting cost is very low, $100. So if you're interested in that on the passive side, you should check it out. What else do we got here? Which may have a better return over the longer period: actively trading options where you can play the up and down side, or investing in stocks. Who wants to take that one?
So, I mean, we can go back to some of the data examples I gave earlier, but, if you think about the long term, back to the 50s, 8% annual return, you can achieve that and double your money every 9 years, given principal contributions. Compounding works. Long-term views work. You can certainly generate income using options as long as you're very informed about their risks and the underlying exposure of not being covered on a position, or underlying owning a long position on the equity. If it's me, I'm very clearly, as you heard today, going to pick the long-term view using equities in a balanced portfolio that's diversified across all segments.
Got it. And then final question here for both of you is, what indicators do you look at to determine if the market is healthy or unhealthy? Steve, you start.
All right, so at VectorVest, we definitely have a unique approach, and you're not going to get the job done with just a MACD or a stochastic, sort of these technical indicators and things like that. So just to give you a little background on VectorVest that may help, is we advocate that investors, when you're buying for the longer term, buy safe, undervalued stocks rising in price, okay? So in order for us to call the market healthy, we have an indicator called the buy to sell ratio, which right now on a scale of 0 to 2 is actually coming in after today's action at 1.01, okay? Just to give you a frame of reference. What that means is the market's at a teeter right now. It's neither healthy nor unhealthy, okay? Moments or earlier this week, it was coming in below 1 for the past 3 days. But the key then is, let's wait for the market to show a little bit more robustness before we start putting hard-earned capital back to work at the market. But the answer to the question, I guess, inevitably is you need a tool that gives you that kind of information. You need there's probably lots of different tools that are out there, but just to put things in perspective, VectorVest has been around since floppy disk. You guys remember what floppy disk even looked like?
Yes, we're old enough.
So we've stood the test of time. We know what we're doing, but in order to get that, now I will say this: if I were to give somebody just something that they could use outside of the VectorVest arena of things, and I think that's also always important, okay, is just use a 50-day moving average on the Dow or on the S&P. If the S&P is trading and moving higher and above the 50-day average, you know that the market is healthy. The market, that's an average of 500 of the best companies in the U.S., good old U.S. of A, right? So if that average is marching higher, the market's healthy.
I'm much more of a fundamentalist, Lindsay. Price to earnings ratio, look at value in the market, look at companies that are undervalued. But going back to the core root of the presentation, I'm looking at the long view, and if the market's dropping, I see it as a buying opportunity this year. If you bought on the way down, your aggregate returns are going to be pretty good at the end of the day, given buying the dip.
Well, on the subject of PE ratio, if we take a look at the current PE in the market, it's at what, second or third all-time high, if not higher than that. There's more risk right now by PE than anything else. So would you be advocating putting money into play in the market right now, or not putting money into play in the market?
If you're asking about fundamental analysis, I use that ratio, Steve. But at the end of the day, it's the long-term plan, and I'm going to be buying into the long-term views in the market and still going to be contributing.
Now, the one thing that I would encourage people to do is at least consider adding growth rate to that equation, because if there's one attractive segment of the market that I would continue to play, moving forward, since we are trading at ridiculous valuations, okay, it would be high growth. And there's lots of stocks out there with growth rates that you can't even, possibly imagine right now. Like a Digital Turbine or, these kinds of companies are really, it's almost, have any of you ever read Schumpeter out of Australia? You were economics, right, Lindsay?
I haven't read that. No, I was finance and marketing.
Are you finance and marketing? Okay, so Joseph Schumpeter was an economist out of Australia, and he supplied us this whole notion of how capitalism survives, right? And that comes down to ingenuity, essentially. There's a creative destruction process that he talks about. We're in the midst of that creative destruction process right now. And what you're seeing is new companies evolve and change and adapt and overcome. So you've got companies like Zoom, Peloton, all these different companies that are taking advantage of what the current situation is and are going to be able to carry the market forward. That's where your high growth is too, by the way. So if there was one thing that I want to try to provide some information people can grab hold of and use, if there was one thing that I was going to go after, that I would go after in this market, it's high growth.
Okay. We're going to probably have to leave it there. I will say one note on PE, though, Steve. Low inflation and interest rates basically at zero do allow for higher PE ratios, though we still remain somewhat stretched. We'll see how that develops over time.
Yeah.
The PEs kind of get stretched at peaks and troughs of the market. Anyway, this was like such a great debate. So many good points by both of you. I'm glad that we came to a conclusion where we met in the middle. That just makes me so happy, a lot easier. And again, thank you for your contributions. Before I let you go, though, what's the best way to get in touch with you, Steve, or VectorVest if our viewers are interested?
Yeah, best way. I mean, if you like some of the things that you heard today, or at least want to investigate it, just wanted to pique your interest more than anything, as to get into the nitty gritty of things, really. But if you go to vectorvest.com, on the vectorvest.com website, there is a start a trial link, and you can try VectorVest out for 30 days for just $9.95. The other thing is, feel free to reach out to me. I've been doing this for 19 years. Okay, so I know an awful lot about the system, an awful lot about investing and trading and things of that nature. Feel free. I'd be glad to try to help anybody. I'm a huge advocate, for getting people into the stock market. And so Steve C at vectorvest.com. Steve C at vectorvest.com would be my email. Okay.
Ally.com 24/7. Anytime you need us. You know where we're at.
And Ally Invest. And we're here on YouTube and a lot of other places. So thank you again both for your time today, for the conversation, for the thought-provoking.
Great combo, Steve. Thanks,
yeah,
Lindsay.
man.
Thank you for having me.
I enjoyed it. And we love Ally. We're actually kind of partners in a way, right? We at least have an API where our folks can trade through you guys. And we're just delighted to have you as, part of the family, quote unquote.
Thanks,
yes,
Lindsay.
well, thank you.
Appreciate it.
For your partnership.
Yeah.